Hello and welcome to Livewire's CIO Profile Series. My name is James Marley. I'm the co-founder of Livewire Markets, and today I'm joined by Chris Watling, who is the Chief Market Strategist of Longview Economics. He's just got off the plane from London, and he's got a couple of hot calls in the market, having effectively seen the recent correction hit markets and alerted his institutional clients to the fact that that was coming through. We're going to have a chat with Chris today about how he's seeing things in the wash-up from the recent market correction, and also get a bit of a view from offshore as to how Australian investors should be thinking about the outlook and also asset allocation. Chris, welcome back to Sydney.
Thank
Great
you.
to have you here with us, and well done on your call from the 17th of January.
Thanks very much. Yeah, I mean that's one of the things we work hard to try and get right. You can't do it all the time, but sometimes, as long as you hit rates above 50-60%, I think it's a worthwhile thing to do. Yeah.
Well, let's jump into that quickly. On the 17th of January, you told your clients that you felt it was time to move away from equities or have a more cautious stance.
Yep.
What prompted that view?
Well, a bunch of things really. I mean, all sorts of things. You think about the prior 2 years. I always think in my head I have this sort of rough roadmap that every 2 years there's a major sort of correction in markets. Within a bull market, you get major corrections roughly. It's a rule of thumb. It's not precise. And of course, we went through 2017 and everything was absolutely wonderful. We barely had any cracks in the market. It was actually pretty uninteresting if one's honest, but great for making money. And then, of course, you get into 2017 and the narrative starts to change. And we had all the great investors coming out and talking about the melt-up, you know, Jeremy Grantham and Bill Miller. My favorite was Ray Dalio in Davos, telling people they'd feel stupid if they held any cash. And that was probably a few days before the top. Not that I don't think he's a great investor, of course he is, but it was a great line. And so there was all that, and then there was really our models. Our models measure what I call risk appetite, but then they measure excessive periods of risk appetite. And sell-offs are really, people always after the event tell you what they're about. Before the event, you can have some good insights into them. Nothing's perfect, but some very good insights by looking for excessive periods of appetite for risk. So that's why it relates to what I say anecdotally about investors getting sort of overexcited about the melt-up. You typically get that narrative at the same time as you get our models saying people are all in, they've kind of overdone it in their enthusiasm for equities. And so we need a washout of positioning. And really that's what I think we're having at the moment.
So you touched on a few of the quotes where people talking markets up. What were some of the market indicators where you could see that over-exuberance? What are some things that people could look at and see in markets?
Well, it's very hard. You have to be careful because a lot of indicators out there you shouldn't look at that people do look at. Things like sentiment indicators. So sentiment is a terrific way of gauging the sort of mood, but sentiment can be bullish for long periods of time before you get a sell-off. Technical indicators can be overbought for long periods of time before you get a sell-off. So we design these proprietary models that look at risk appetite daily. So across the globe, across 3 different time zones, across all asset classes, we measure the market's actual appetite for risk each and every day. And that tells us when people are overdoing it. They're buying high risk and selling low risk, and you can see it in the models over sustained periods of time. So you've got to have the right kinds of models, but if you've got them, you get the right kind of message.
So let's move it forward to where we are today. Was there anything to learn or anything to take out of the washout that we had? What now you've had some time to reflect on it. Is there anything more sinister than a bit of a correction and a healthy pullback, as people have been quoting? Yeah,
one immediate lesson is when everyone calls it healthy, it's clearly not finished. You need a bit of fear in there to feel you've got that proper risk aversion in market prices. But anything to learn? I mean, I think sell-offs sometimes do have some macro factors associated with them, and I wonder, and I wouldn't want to be more precise and more dramatic than that. But I wonder if we're starting this proper withdrawal of liquidity environment, and we're going to see a very different world over the next year or two. This is not our central case, but what worries me is that maybe we have seen a top in this bull market, and I think that's something we have to watch for very closely.
One of the big risks that I keep hearing people talk about as the one to watch is global growth picking up, interest rates are on the move, central banks are going to be hiking, bond yields are going to be going up. Is that central to your outlook at the moment as well?
Well, part of that is central, but yes, central banks are clearly hiking rates. But if you think about the yield curve and 10-year bond yields and the idea they're going to keep on going up forever, I'm not so convinced. Because let's not forget the major themes that we were all talking about a couple of years ago. We're in a world that's got more debt to GDP, more zombies, and really, I think, a broken economic model. So that's not a world where I see 10-year bond yields going that much above 3, really. I think 3 is a sort of level. But I think short rates will go up because central banks want to move them up. They see wage inflation coming, a little bit of cyclical consumer price inflation, so they're responding to that. So that is actually an environment where the yield curve flattens and then begins to invert. So I think bonds are looking reasonably interesting here.
Okay, just dial back a bit. You mentioned the word zombies.
Yeah.
What are zombies?
The zombies are here, yeah. So zombie companies are companies that can't really afford their own interest payment. So we did a study of zombies across 18 countries late last year, middle of last year. 17 of those countries have about 10 or 12% of their listed corporate base are zombies, so they can't cover their own interest payments.
So that's the definition of a zombie, that is a company that doesn't make enough money to cover its debt.
Exactly, and it's been around for 10 years. This is not new startups, we're getting rid of those. This is not banks and finance, this is just plain vanilla companies can't fund their own interest payments out of their earnings, basically.
And why is that an important group of companies to be focused on?
Well, what that's telling you is telling you there's a weakened corporate base across the Western world that won't respond well to terribly high interest rates. So it's another reason I think yields can't go that high, if you like. It's just, so today we said it's like 10 to 12% of the corporate base. Wind back 15 years before we went into sort of mad cheap money forever, it was 1 or 2. So it's a very big increase in the corporate base. And people talk about productivity. Why is productivity so weak? Well, if 12% of your corporate base is barely alive, they're not investing, and they're undermining the natural Schumpeterian creative destruction process, if you like.
Okay. Well, let's pick up on bonds there. We talked about 10-year bonds. You don't think they can go much higher, and in the short end, you think they will start to rise. Just explain to me what that dynamic means and why you think it's interesting.
Yeah, I mean, it's really important because the short end is basically controlled by the central banks. So 1-year bond yields, 2-year bond yields is basically telling you about what the market expects the central banks to do. So it's the central bank's reaction function, if you like, how they behave, that will govern the movement of that. The 10-year, I think, is dominated by how the market sees the strength of the Western economies, the world economies, and so on, and how they'll respond to those interest rate hikes. And the two aren't necessarily moving in the same direction all the time. I think, and this goes back to Greenspan's bond yield conundrum back in 2004 and so on. You may remember Bernanke had a savings glut thesis, all that sort of stuff. But my point is the central bank's reaction function is we see labour markets tightening, wage inflation trending up, bit of consumer price inflation coming back into the system. And people use that to talk about the 10-year. I think that's wrong. I think it's more important to talk about that in the way the central banks react, and therefore they raise rates. And the 10 years, I think, will therefore come off. So then you're thinking about probably one of the best indicators of recession out there, there's lots of them, is the inversion of the yield curve, which is when the 10-year yields are below the 2-year yields. At the moment in the US, it's about 50, 60 basis points, 10 years above 2 years. But if I'm right and 10 years don't go up much more, and we get a few hikes, you'll get that inversion maybe later this year, maybe early 19, mid-19, something like that.
And that's generally considered about a 1-year lead indicator to a recession, is that correct?
Yeah, 6 months, 12 months, maybe a little bit longer, but yeah, it gives you a good heads up that a recession's coming out there. And it's been really good indicator since we've been in Bretton Woods since the early 1970s.
So that view really seems quite at odds with the story that we're hearing about the strength of the global synchronized growth right now, corporates doing really well. How do you explain that?
Well, I think that comes back to the fact, as I was saying earlier, that the structural drivers rather than the cyclical, that's all the sort of cyclical story. The actual structure of the world economy is not better than it was 10 years ago. I would argue it's worse. Asset prices are elevated on cheap money. We've got all these zombie companies that aren't operating properly. Productivity growth's under pressure, is not really coming through. All these sort of structural weaknesses. You look at the US household savings rate, it tends to Typically it'd be around 5, 6, 7. It's now down at 2% and change, lowest it's been in pretty much 40 years. So that tells you about the way we've grown economies. More debt, more borrowing, tapping into savings. It's not structurally good, it's structurally poor. So that's why I think the bond yield is probably pegged to around 3-ish.
And is a lot of this focus here, is it around the consumer that you're concerned about? Is that the weak link in this current cycle?
Well, it's the consumer, it's the zombie companies, and of course the governments are largely trying to retrench, although Trump's sort of swinging the other way at the moment. But yeah, I mean, I think the corporate base is weakened. The households are heavily indebted. They, in some parts of the world they deleveraged a little bit, and then they're releveraging again. But there's been no dramatic deleveraging in any major economies. We've had it in sort of Iceland and the Baltic states and places like Ireland, perhaps, but not in any significant economies. If they deleveraged, they might have flatlined at best. If you look at, and talking of debt, I mean, I was just looking at how much US government debt's on the table. 10 years ago, they had $6 trillion US dollars of government debt in the States. They've now got just short of 17, 18 trillion. So in 10 years, they've almost tripled their own debt, and off we go with some fiscal stimulus at the same time.
Well, it doesn't sound like that pretty of a backdrop, but you do need to have a view on how to invest through this particular part of the cycle. Can you give me your baseline view, and maybe put an Australian lens, if you could, for us on what places to avoid and the sorts of assets that you're looking at against this backdrop?
Yeah, I mean, let me start with the equity versus bonds question, because really 80% of returns are getting that balance right between equities and bonds, and then you sort of add little bits by going further down the chain. So I always think the first most important question investors have to think about is, are we in a cyclical bull market or not? And we sort of touched on it a bit earlier. And bull markets are about cheap money, US economy, global economy expanding in an absence of shocks. And money is still cheap. They're starting to withdraw it, but it's still cheap. Our liquidity indicator is like about as plentiful liquidity as you can get. So money's cheap, the US economy is expanding, it's got a new fiscal stimulus in there, so that's all good. And of course there are shock risks, there always are, but there's none that are, other than the fact we're in a bit of a shock sell-off at the moment, if you like. There's nothing that's obvious on the can at the moment. So I'd be overweight equities, point one. And then from an Australian point of view, the question is, do you want to bias to Aussie equities or you want to bias to overseas? And for me, that's really a question about the currency and about the Australian economy and about all those sort of factors.
Well, let's talk about that. Let's maybe start with the currency, because the Australian dollar it's been pretty resilient.
It's been resilient for a couple of years, that's right. And of course, the currency in Australia and the Australian economy is deeply linked. And, I was pretty bearish 2 years ago on the Aussie economy. And it's deeply linked to the way China behaves. And of course, China drives a lot of commodity prices. But I think if you look at Australia today, I don't think many people would disagree. Maybe they would, but it's not quality, exciting growth. It seems to have somewhat limped through in the last couple of years. It's obviously had Sydney and I think Melbourne house prices have had another good run for a couple of years, and that seems to be topping out. Household cash flow in Australia doesn't look that good looking forwards. We have a model for that, and that doesn't seem to look too impressive. The iron ore prices helped, other commodity prices helped. So the question is, what's really behind those? And the answer is China, and a massive fiscal and monetary stimulus from late 15, early 16 that ran all the way through to mid 17 and is now rolling off. So you've got to ask yourself, why is Chinese growth so strong? And that's really the Australian question. And the answer, I think, is we've actually flipped into a credit boom on another balance sheet in China. So really timing Australia is about timing that Chinese consumer credit boom, in my opinion.
Mm-hmm. There's been lots of doubters around the ability for China to maintain the head of steam that it has, and it seems to have defied all comers. Yeah. When you have your views, do you think about why you could be wrong on some of this stuff? Yeah,
sure. I mean, no one's right all the time. We all make mistakes. Absolutely, we're human, and it's the future. It's difficult to predict. I think where we went wrong on China a couple of years ago was we weren't completely up to speed in the way they were flipping into a different balance sheet. So if you look at the old economy, Chinese old economy is just now is flatlining. There's not a lot going on there. In fact, so look at imports of iron ore or cement production. In the last couple of months, they're contracting. So, that part of the economy is slowing. The consumer credit has grown by $2.4 trillion in 3 years. There's a big debate about what are they using it for. The $2.4 trillion of consumer credit, which is arguably spending power, is equivalent to 20% of Chinese GDP. Now, UK consumer credit is about 18% of GDP. We've been growing that for 20 years. They did this in 3 years. This is like South Korea in the late 1990s. Now, I know a lot of consumer credit goes into mortgage borrowing, and it's a bit sort of unclear where exactly it all goes. But even if you take a third of that number, a third of 20% of GDP over 3 years is 2 percentage points on growth per annum. So instead of 6.5%, 7% growth, it's really 4.5%, 5%. So there's a big difference there. Mm-hmm. Now that's cheap money. So, it depends how the policymakers play out. The bulls will say everything's under control. The Communist Party pull all the levers. But yeah, that's the risk there. And so
if you were to bottle it up, what's your base case for Australia at the moment? Is it, if you were to touch on things like, the currency and then, sort of outlook for equity markets, and you might even want to roll into that what the RBA might be doing?
Yeah, so, I think global equities will be higher over the course of this year, and Australian will go with it. Yep. It's been underperformance for a couple of years, but I think that'll go with it. In terms of the currency, the market's very bullish now. Positioning's quite high in the Aussie dollar. People have changed their view on that, so I think you want to lean against the wind there. I think, as I say, the Chinese economy is rolling over, and I think the Aussie dollar will go with it. Yeah, the RBA seem to want to be on hold for a while, as far as I can make out. And I think global rates are going to go up, and Australia might try and chase it a bit, but I don't think the economy can really take it. So I still think, I said before, I think Aussie rates are going to zero, and I still think they are.
Still a chance?
Yeah, I still do. I mean, they'll probably go up before they go down, but I think the point is the debt here is so high. And the house prices are high. It's an expensive economy. It's been living on Chinese commodity price, borrowed time. It's an awful long expansion. All these things are very well known. But, I think that level of indebtedness is a problem.
People love to worry. What are some of the things that asset classes and parts of the market where you think investors would be served well to tread very carefully?
Well, I think the first thing you want to tread carefully on is high-yield corporate debt. So, I mean, it's well discussed that Eurozone high-yield corporate debt yields roughly 2.8%, so the same as US Treasuries. And this is supposed to be junk. We kind of forgot it's called junk. Now, of course, a lot of that relates to all the ECB QE programs. And US high-yield debt isn't much better, so be careful there. I think equities can do well, but one has to be slightly careful about the rich valuations. I think if we're moving into a phase where the US dollar starts to rally, I think again emerging markets maybe have had the best of their times, and then maybe should be a little bit more cautious there.
So when it gets down to the crunch, while you're here in Australia visiting the investors that you speak to, what's going to be the message? What's going to be the long view strategy that they hear?
Well, the long view strategy is there's probably a little bit more to go for in this cycle, but we're clearly well advanced, and the liquidity issues are really starting to be a little bit troubling. We have these canaries in the coal mines, sort of 4 key economies of the world that I think will start to struggle first in response to global tightening. Australia, the UK, Canada, and China. And there's a couple of emerging markets in there as well. So going back to those 3 factors that drive bear markets and shock risks, I think these canaries in the coal mine are things to watch. Look at the UK. The UK housing market looks like it might be rolling over, which is a key thing that takes us into an economic slowdown and recession. So the world's built on an edifice of cheap money, and we're trying to remove it. So it's pretty troubling times.
Great. Well, Chris, thank you very much for coming in. Great to catch up, and have a great time in Sydney.
Thank you. Appreciate it.